Welcome, guys, to another episode of the Evolution Podcast. So today we're going to be talking about taxes. Listen, I don't know if you guys know this, but the more money you make, the more the government takes. So we're going to talk about tax strategists here with the man himself, Thomas. If you want to go ahead and introduce yourself.
Hi, yes. Thanks for having me here today. My name is Thomas Castelli, and I'm a CPA and tax strategist, and I work with real estate investors to help them keep more of their hard-earned dollars in their pockets and how to the governments through like tax strategy and planning.
Got you. Also, guys, if anyone from the IRS is watching this, just want to let you guys know that we'll be doing a very friendly conversation, and it will be all legal advice. But Tom, so talk to me. So how'd you get started in the business?
Yeah, so basically, long story short, I went to college for accounting. My parents always told me to go to college for accounting, and I really didn't know what else to do at the time. So went ahead and did that. And then kind of like while I was in college, I realized I'm like, all right, this whole entire like the 9 to 5 grind isn't going to quite get me to where I want to go. So I started reading a bunch of books like Rich Dad, Poor Dad, books like that. And there was this common theme in there about real estate. So when I was my last year of college, my senior year, I started attending networking events and meetup groups regarding real estate investing. And what I ended up meeting this group that was doing a 3-day weekend on syndication. And I decided to go to their boot camp prior to starting my first full-time job that summer. And from there, I fell in love with real estate syndication, the model, how that worked. And kind of from there, the rabbit hole goes pretty deep. Now, I was working at a large firm for a while, but then I came to the conclusion that like the corporate world isn't really quite where I wanted to be. So I ended up teaming up with Brandon Hall here at the firm that I'm at now. And that's how I kind of got into marrying my tax background with my passion for real estate investing and became a tax strategist for real estate investors.
So for those people who aren't familiar with syndication or what real estate syndication is, do you mind just giving like a quick pointer on what real estate syndication is?
Yeah, absolutely. Absolutely. So when you, as a real estate investor, you can go buy a property yourself, right? You go put the down payment and then you go ahead and go to the bank or you obtain other financing to go ahead and buy that property. Now, with larger properties like apartment buildings or office buildings, retail centers, and other similar properties, sometimes they're so expensive that it's really challenging, if not sometimes impossible, for really one, I don't want to say impossible, but really challenging for one person to take down themselves. So what ends up happening is people will pull their money together to go ahead and buy a property. So typically how these transactions work is you'll have a general partner or a sponsor. They'll be in charge of running the deal. So they'll identify the property. They'll do the due diligence on the property. They'll go get the financing from the bank, and then they'll raise money from investors, also known as limited partners or passive investors. And those limited partners will provide the equity for the down payment and typically the renovation budget and other expenses associated with the transaction in exchange for an equity stake in that property. So basically, it's kind of like it's basically a bunch of people owning a property together, effectively.
Got you. So, okay. So what's stopping an individual, like for instance, Grant Cardone, because I know Grant Cardone has like the accredited and the non-accredited investor. Are you familiar with Grant Cardone?
Yep.
Yeah. So now what's stopping somebody from just saying, you know what, I'm going to go and just do the business with a bank. I'm going to buy this property and I'm going to have the bank with me as a partner. Why not just go with a bank?
But it's certainly possible to do that. However, let's just say, for example, you're looking to buy a $50 million building, right? Let's just say that you had to bring a down payment to that at 20% or 25% down payment to that. You're looking at 12.5 million plus closing costs plus renovation budget. So you're looking at a significant amount of upfront capital you need to take down that property. And sure, while a high net worth individual might be able to do that themselves, if you're not a high net worth individual, typically it would be very challenging for you to do. So that's kind of why syndications exist to help people take down these larger properties, to give investors an opportunity to get access to these larger properties where they might not be able to in other cases.
Got you. So like, let's say I'm an everyday individual and let's say I make about $100,000 a year, hypothetically. And I just wanted to, I really wanted to own real estate, right? And I know, hey, I want to get into the apartment building, which is, 14, 15 doors and it's 1.6 million. And now I'm like, okay, the bank is asking for 20% down or whatever it is, and I mean 20% down of 1.6 million is what, 320 grand, right? So it's like most people don't have 320 grand. So then you'd go like, hey, so will it is it a situation where you would form a syndication to come up with 1.6, or is it a form of syndication to come up with a down payment?
Yeah, so typically you form the down payment, and then you would go to the bank and get the financing from the bank from there or another lender.
Got you. Okay, so now I'm very curious what's your take on this, right? So because I really want to talk about that, but do you think, remember the 2008 crash that happened with mortgage bonds, the whole 9 yards, right? Do you think commercial real estate is probably going to be one of the signs that we're headed towards a recession?
Yeah, that's a great question. So the interesting thing, so back in 2008, what kind of happened was a lot of people, the 2008 crisis came down to it that there was banks and other lenders that were giving mortgages to people who did not quite qualify for them. And so people were taking on too much debt, and then they'd roll up these mortgages into these what they call the mortgage-backed securities, and would sell them. And the appetite for that investment product became so strong that they kept doing this. And then what ended up happening is people couldn't pay back their loans, and the financial system kind of collapsed on itself. And that's kind of what led to, like, long story short, what led to the 2008 financial crisis. And I think this time around, for the most part, it's a little bit different. Banking the lenders have much stricter standards, so you're not seeing all these subprime mortgages going out and people who can't afford to pay it back. So I don't think you'll see that as cause for recession necessarily. I think, though, what is going on, though, what is an issue is the high interest rates that you're seeing right now is causing people to have less discretionary income, right? Like 2 years ago, I was looking at a property that I was going to buy personally for personal use, and I could have gotten a 2.83% interest rate on that. That same property now, depending, could have upwards of an 8% interest rate. So now there's a few $1,000s delta on a monthly payment that I would have, assuming I bought the same property, could have spent on anything else. And that is leading, and now because people don't have that money because housing is increased, then that's one thing that could lead to a recession. There's also a few other factors going on right now. For example, the pause on student loans also came due, or was recently came due, if I'm not mistaken. So that means all the people who were deferring payments during COVID effectively on their student loans now all of a sudden have this other expense that they have to pay, and that takes money out of their pockets they could pay for discretionary income. And then you have the rise in gas prices that now have pretty much stabilized for the most part, at least in where I live. But a few years ago, they were much lower. So all of this takes money out of people's pockets and makes it harder to do business, right? And then one last thing I'll say is that the higher interest rates also make it harder for business owners to expand their business and create more jobs. So when you combine that with the fact that there's less discretionary income floating around out there, that could lead to the recession that we're seeing. I don't think it's going to be the housing market in and of itself.
Gotcha. So if I'm recapping, understanding, it's just the fact that people don't have that much money in to spend per se. So in this instance too, so what I'm thinking of, because most people don't understand what a recession is, right? Most people don't understand. Can you just give a little bit of explanation, like what are the signs you would know from a perspective, from your perspective of being in a recession?
Yeah, that's a great question. Some signs of being in a recession is that this is a tough one. I haven't broken down a recession in a while, but basically a recession is when people when the gross GDP is not growing is actually taking a negative step back, like the gross domestic product that the country is doing. And that's usually as a result of some of these factors that I had mentioned. So if there's, it's mostly the monetary cycle and lending, right? Because if interest is at 8%, if I want to go buy, say, for example, say I'm a business owner, say I own a manufacturing company, just for example, and I want to go expand to a new plant. Well, now I need to go take out a loan to go buy that new place, or I need to take out a loan to buy new equipment, so on and so forth. I need that capital from somewhere, and that cost of capital is now increased. So that might prohibit me from actually expanding my business. Or the cost of capital could actually cause me to have to shrink my business, because where, say, I had a loan that was coming due on a piece of my business that now I have to renew at this higher interest rate. Well, I might not be able to afford that loan now at this higher interest rate, causing me to have to potentially shut down part of the business, right? And because of that, there's less being produced, and it kind of, in a nutshell, at least in a nutshell, the way I see it, creates a recession.
Interesting. So if because the way I'm looking at it from a perspective of, okay, so you have the Fed raising interest rate, right? I think it's at 8% now, right? The current interest rate, it's roughly around 8%.
Yeah, I mean, I looked at the mortgage rates the other day. It was like over 8% even if you had like good credit, like 760 plus. So
yeah, which is interesting because the people that it benefits are cash buyers, right? So if someone's, which even though I was a cash buyer, right, is it even advisable to pay a ridiculous amount of money for, like, you pay 600 grand for a house that was worth 200, and you still have to get work done for another 50, 60 grand,
Yeah, no, it depends. Well, paying 600,000 for a house that was worth 200,000, probably not going to be your best bet. Just because, like, the delta of how much you'd have to improve the value to make that investment worthwhile is so high that it can make it highly risky. So, like, I would say, like, if you're going to, it depends. Like, if you're going to slightly overpay for a property in a market that is booming right now and is most likely going to continue to boom and prices are going to continue to appreciate, that risk might be worth taking. But most prudent investors will say that you want to buy below replacement cost. You want to buy below intrinsic value. Mm-hmm. So if the property is valued at 600,000, you want to buy at 200,000. You want to buy at 150. You want to buy at 125. You want to buy less than that, because then you have a lot of safety. But what ends up happening, especially at the top of the market, is people start overpaying for assets. And that's when you kind of peaked, and that what's going to come next is going to come the recession. So to answer your question, it depends, but overall, it's hard for me to recommend buying, at inflated prices.
It's interesting because it's people who pay cash for a property that wasn't worth anything. Usually consumers just like, hey, I'm moving from California and I want to come here and buy it. So I'll give you a story. Someone, this is not a personal story, man, but there's a friend of mine telling me his barber, his house was worth 250, 200, and now the house is worth 430, 460, give or take. And he's like, dude, I'm going to sell. And he wants to sell the house. Like, he really wants to sell. But the reason why he wants to sell is because he's like, all right, I'm going to sell and I'm going to go live and rent for 2-3 years and wait for the market to tank. And then I'll buy. So buying his interest rates. Now, I was thinking from a perspective of that's capital gains tax, right? Because you make the spread of 200, but most people don't think about capital gains tax, right? So what is capital gain? This is just a very interesting question. What's capital gains tax on a property that you're selling? And is there a way to avoid it?
Right. So capital gains tax is basically when you buy a property, right? You're going to buy it with a purchase price, and over time, it's going to increase in value, or at least you would hope, right? It appreciates in value. So capital gain is going to be the difference between the amount you're selling it for and the amount you bought it for. Now, how can you avoid that tax? Well, for personal residences, if it's your primary residence, you can typically exclude up to $250,000 of capital gains from tax if you lived in the house for at least 2 out of the last 5 years, and that doubles from 250 to 500,000 if you're married. So if you have a primary residence, that's known as the home sale exclusion, and many people qualify for that if they've been living in a property for a long time. So that's a great way to avoid taxes on the sale of your residence. But if it's an investment property, things get a little bit different, and you can't use the home sale exclusion for the most part, or it's not going to be the most viable strategy in all cases. So you're going to be looking at using a strategy like the 1031 exchange to defer your capital gains tax. And the way the 1031 exchange works, long story short, is you sell your property and you find a replacement property, as they call it, and you buy that replacement property, you do the 1031 exchange, and now you've deferred the capital gains tax, the capital gains, and you kick the can down the road because you use the sales proceeds from your original property to buy another property. So from a personal residence standpoint, home sale exclusion can allow you to exclude again up to $500K in gains if you lived there for at least 2 out of the last 5 years. Or if it's an investment property, you're going to want to look at a strategy like the 1031 exchange to help you defer the capital gains taxes to a later point in time.
Got you. So like, I just wanted, so just to curious. So let's say, I have an investment property, and let's say I sell my investment property, and based on the equity, I'm, made like 300, 400 grand. And I'm like, all right, you know what? I'm just going to wait before I buy the next one. Even though I didn't live in it, it's just an investment property. Now, is there a timeline for which I can use the 1031 exchange, or is it more of like, hey, you can take your time?
Yeah, so you do have a time limit. So with the 1031 exchange, for you have 180 days from the date that you sell your property to acquire at least one property that you identified, right? So, okay, let me break it down like this. So, from the date you sell your property, you have in the first 45 days from the date you sell your property, you have to identify typically up to 3 properties that you want to acquire as the replacement property or as the new property that you're going to buy into. Now, from there, you have a total of 180 days from the date of sale, including this 45-day period to close on one or more of these properties. So there are timelines to this. And one more thing to note about 1031 exchanges is that you have to work with what's known as a qualified intermediary or a QI. And what they do is when you sell your original property, they take possession of the funds from the sale of your property and hold it in escrow until you're ready to buy that replacement property. And then they go ahead and release that money from escrow to the seller of your new property so that you can go ahead and buy it. If you actually take possession of those proceeds at the closing table for your property you just sold, then you just killed your 1031 exchange. So what I'm trying to say here is that you're going to want to work with a QI. If you're considering using a 1031 exchange, you're going to want to work with a QI so that they take possessions of the funds of your sold property so that you don't blow the 1031 exchange. And then you're going to want to realize that there's a 45-day period to identify properties to buy, and then a total of 180 days, basically 6 months, to close on one of those properties.
Oh, that's interesting, man. Because I knew about the 1031 exchange, but I don't think you broke it. The fact of the QI, because I'm like thinking you liquidate and you're like, all right, I'll take the money. And then next, you're like, IRS is like, well, hey, listen, you forgot to give us our cut, which is very, very, that's fascinating per se. Just thinking about that. Now in the tax. So this is a very funny one. So, when people say rich people don't pay taxes, they don't pay any taxes, they're like, for instance, people like, a lot of people like Bezos didn't pay any taxes. And can you explain to us how it is that, you have wealthy individuals legally are able to go without paying taxes?
Right. So they might be able to pay no income taxes or very low income taxes. I find the phrase "the rich pay no taxes" is just not true.
Mm-hmm.
The rich, like Jeff Bezos, for example, his company Amazon employs thousands and thousands of people. They're paying taxes. They're paying like the FICA taxes on behalf of their employees. So they are paying taxes, and there's other taxes in there. So that's not quite true. But there are strategies that do allow rich people to pay little to no income tax. And the way that kind of works is specifically real estate. There's something called the real estate professional status. And what the real estate professional status allows real estate investors to do is to take the losses generated by their rental properties and use those losses to offset their active income or their earned income. And that's one way they could basically pay no taxes. So to kind of dive just a little bit deeper into that, basically when you buy a rental property, it's going to depreciate over time. And depreciation is a non-cash expense that you have on your profit and loss statement that can cause you to have a loss for tax purposes, despite the fact that you might have generated cash flow. So to give a quick example what that might look like. Let's say you had a rental property that had $10,000 in rental income. And then you had $5,000 of actual expenses, property taxes, maintenance, insurance, property management fees, so on and so forth. Now you're left with about $5,000 of cash. Now, in most businesses, you're going to end up paying tax on this $5,000 of cash. However, now you enter this non-cash expense called depreciation that only exists on paper, and you might have a $6,000 depreciation expense. So now you have $1,000 tax loss, despite the fact that you just pocketed $5,000. So that's one way. That's one way they do it. Now, what happens with this loss, this $1,000 loss? Well, there's these rules under the tax code known as the passive activity rules, or otherwise called Section 469, if we want to get technical. But what they do is they say that losses from rental real estate are passive and can only offset other passive income and can't offset income earned from, say, a job or an active business that you're running. However, the real estate professional status allows investors to get around that if they spend more than 750 hours and more than half their total working time in real estate. So that's one way wealthy people who are working full-time in real estate, effectively full-time in real estate, can pay little to no taxes. But there's another way, and this strategy is known as like buy, borrow, die. And basically, it's where you buy. This works with rental properties and also works with stocks. So I'll kind of give an example of both. So let's say you buy a rental property, you're renting it out, you're collecting your cash flow, everything's going really well, property's appreciating, but you don't want to sell the property, right? You don't want to sell the property because you like the property, it's a good investment for you, but you need cash. And now all of a sudden you have all this equity that was built up in that property over time, right? Because now the property's appreciated, and you could go to the bank then, get a loan out on that property or refinance that property, take the cash. Now that cash that you got from that refinance is going to be tax free. You're not going to pay any tax on it. And now you still keep your property, and now you have all this cash tax free. That's one way. Now you can do the same thing with stocks. And this is actually how Elon Musk bought Twitter, or X now. Basically, what he did is he took a loan out against his Tesla stock, the value of his Tesla stock. So he used his Tesla stock as collateral. The bank gave him a tax-free loan, and then he went and bought Twitter, and now he still kept his Tesla stock, and he now owns Twitter. So that is another way that the rich pay little to no taxes. They have a business that they own a business, they increase its value, and then they take loans out against their business, and they pay themselves like a little salary. They take loans out against their business, and that's how they tap into that equity and into that cash source.
So I'm curious now, what happens if they default? If they keep defaulting, what happens to the business? Because it's a secured loan for the most part.
Right. Yeah, if they default, they might lose their stock. So what people would do, or the bank might foreclose on the house. So what people would be prudent to do is use debt wisely and hopefully not leverage to the hilt. Like if Elon Musk, for example, I'm just throwing out a number, owns $10 million in Tesla stock, he might only take out a loan of $4 million against that Tesla stock, because now he doesn't like that loan. Put it this way, he would have to sell only $4 million of his Tesla stock, of his $10 million Tesla stock, to pay that loan back. So it's risk management and debt management. It comes down to making sure that they don't lose their assets.
So this is where I'm curious now. I'm asking you this question. Do you think incurring some element of debt per se and being able to manage debt is very essential to success, especially in business or in any realm?
I don't want to say it's essential. There's certainly people out there who succeeded without debt, but debt is an extremely useful tool in allowing you to generate significant amounts of wealth. It's a great tool for leverage. For example, with real estate, if you were to just buy a house cash, right? Say you would buy a $600,000 house cash. Let's just say that property was generating $4,000 a month in rental income, right? And now you have $12,000, 12 months, that's $48,000. Now you're dividing that by $600,000. That was your investment. That's going to be an 8% return, right? So you have $48,000 divided by 600,000, and you're going to have 8%. But now let's say that you were able to use leverage, right? Now let's say you took that same $600,000 property, you put a $25,000 down payment on it. 25% down payment on it. So that's $150K. And now that property still generated, let's say it generated 48,000, but now you have debt. This is oversimplifying it, but now let's say you have debt let's just say the debt's half of that, right? Now you have $24,000, but your $24,000 is only against $150,000, and now you have a 16% return. So being able to use debt allows you to acquire more assets and get higher returns. Additionally, like another example is with appreciation. Like if you were to invest let's say you were to invest $600,000 in stock, right? Well, now you have $600,000 in stock that's earning, or that you're earning a return of 600,000. But if you leverage that, if you leverage it, and now you buy, say, $1.2 million in stock, well, now your same $600,000 is you're earning income or appreciation on $1.2 million rather than 600. So leverage allows you to effectively what's the word I'm looking for here? Magnify your returns. That's what leverage does for you.
Got you. But then did you know it's interesting because there's a whole what's his name? My God, he's famous. My God, he's the guy that debt's bad for you. I know you know him. Dave Ramsey.
Yeah.
Yeah. So you have a Dave Ramsey, because I listen to Dave Ramsey and I listen to Grant Cardone, and I like to take both sides with the whole of the to make a very logical decision. But you have one side where it's like debt's bad. Don't ever get in debt because whoever has in debt is a servant to the debtor. But then again, you also see that 90% of businesses and successful companies all have debt.
Right.
Now, this is where I'm also, which kind of segues into this question I have for you. So, you've heard of creative financing, right? Which is wholesaling, and people who want to go into wholesaling, where you basically just hey, you find the seller, the buyer, and get on a contract, the whole 9 yards. I'm still kind of skeptical about it. Of creative financing, because it just there's a lot of it that doesn't necessarily I don't know, it just feels like a lot can go wrong.
Right. Like, is there a specific type of? There's a lot of different creative financing techniques out there.
So we have one where, and I'm pretty sure, and I am actually going to take the course because I'm I want to learn. I'm very curious about it, because real estate's something where it's a tangible asset, and you're in business with the government, and the government likes people that own stuff because they know you keep the cash, keep the money going. In the sense as to, let's say I find a seller and a buyer, and the seller's like, hey, we're going to lose this house. If not, you come in, you make the 1 month payment, you get it on the contract, you find a buyer, they make a deposit of 20 grand, you keep that. But then now you are responsible for basically whenever they make the payments to you, so you can service the bank. Right.
Oh,
so what happened?
Oh, okay. I'm sorry.
Did you get my point there in that perspective? So it's still kind of a little bit like, what happens if there's defaults, there's all that stuff, because now you just put yourself as a middleman for that's position.
Yeah, it sounds like Section 8 maybe. There's always risk in creative financing. There's risk in anything. It's just a matter of what your risk tolerance is, and are you able to handle it, and are you prepared to handle it? Do you know how to navigate those waters? And if you don't know how to navigate those waters, there's a few options, right? You cannot use creative financing, or you can find like a mentor or a community of people who are using these creative financing techniques, the ones that you're looking to use, and help you navigate it so you're not making those mistakes. But no doubt about it, there's certainly risk with creative financing, and it gets more complex, and with complexity usually comes more opportunity to mess something up. So certainly risk there, but I think learning how to use it and learning how to navigate those waters can make you more successful, make you more wealthy than if you did not know how to use it. If you did not know how to do that.
So let's look at it from comparing apples to oranges, right? Because I don't think syndication and creative finance is the same. But let's say we have an individual right now who is, that same individual is making 100 grand a year, and they're like, all right, I want to make money in real estate, right? And they're like, okay, I can't necessarily pull together and create a syndication, or they don't know about syndications, but they know Susie down the street that's like, yeah, I make 50 grand a month, I do creative financing, because it's something that you can basically get into for low investment, right? You don't need quite the same. Why should someone get into a position where they're having to syndicate as opposed to a position in which they could just go creative financing? What would you say is the better of the two?
Yeah, that's tough. That's definitely a tough one. Yeah, it's tough. Usually creative financing is used with properties, at least in the real estate context, with properties that you would take down as an individual, right? So that comes down to, do you like to have control? Do you want to own the property long term? That's something to consider, right? With syndication, if you're going to go syndicate a property, right? If you're going to actually be the syndicator, and now you're actually going to be the one in the driver's seat making this happen, it can allow you to take down a property that you would not be able to take down yourself. It's a little bit more, I mean, there's risk there too, but like the syndication, it's tried and true. You know what you're getting. There's a model to it. Honestly, this is a hard question to answer because it can go either way. So I guess it depends on what your goal is. If your goal is to own a property, lock it down long term, that you want to own it, you want to control it, you want to have the majority, if not the entirety of the equity in that property, then you're probably better off going with a creative financing solution. Whereas with syndication, you're giving up a substantial amount of equity. I guess it's the best way to put it. You're giving up a substantial amount of equity, usually somewhere between like 30 to anywhere between 20 to 40% of your equity is going to investors. And investors are going to have more equity in the deal than you do. And then usually with syndications, there's a cycle. With syndications, you're usually going to sell it between 5 and 7 years. So, and then you're going to, because you need to keep your investors' money moving. So I guess to put it succinctly, if I was going to have to say which is better, it depends on your situation. If you want to own the property long-term, probably go with creative financing. If you want to buy a property, you want to make some money on it, you want to turn it around, you want to sell it within 5 to 7 years using other people's money, syndication might be the way to go. But there's risk in either strategy for sure.
Okay, so on one end with syndication, I'm thinking from a perspective of, okay, I want investors, right? So which means I have to get them to trust me with their money. Let's say we got to pull up 300 grand to deposit, 360 to deposit for a $1.6 million house. And I'm thinking about it from a perspective of, okay, I got to get each person, for instance, let's say to put in 50 grand, right? And you have to manage and keep the money moving. Now, from a perspective of one, how will the payouts and the legal structure work amongst the person, who's running the syndicate and the payouts to the investors? And then how do you necessarily keep the money moving so that the investors aren't losing money?
Right. So that's a great question. So usually these terms are kind of set up front. So when you present your offer to the investors, you're going to say, hey, look, this is the plan for the property. We're going to hold it for 5 years, and this is your projected returns. And usually at that point, they're pretty content if they've invested in these types of transactions before, or you educate them properly. If they haven't, then they're usually okay with that. They realize, okay, this is going to be a 5-year deal, and I'm comfortable getting my money tied up for this rate of return in this structure. Now, as for the actual structure of the deal, there's different ways you can do this, but typically what you'll see is there's kind of two different parts of this. You're going to have a preferred return, and the preferred return might be, say, 8%. And that means that investors are going to get at least 8% of their, at least a return of 8% on their money before the general partner or before the sponsor gets paid anything. And then beyond that, there's going to be a split. There's typically going to be a split in the profits and sales proceeds, or the gain on sale effectively. And that split can be structured like, basically, it's usually structured something like 30% to the sponsor and then 70% to the investors above that 8%. So that's kind of one structure, but it's kind of, you could be flexible in there. Some people do 80% to the investors, 20% to the sponsor, and then things can get more complicated with waterfall structures, as they're called. And waterfall structures are basically where, like, not everything is split directly 80-20, right? It could be split 80-20 up until a certain point of return, and then split a different way beyond that, like 50-50 beyond that. So the structure of these deals you can get creative in the way, I guess you could say, or there's some room for flexibility in how these are structured, but that's kind of how it's done in a nutshell.
Interesting. So, okay. So now I want to, which brings me to my next question. So I'm watching this right now, and I'm like, you guys talking about some crazy numbers: 1.6 million, 360 grand, talking about syndication, creative financing, and we have an individual that's watching this right now that's probably making 30, 40, 35,000 a year, because the average income is what, I think 30 or 50 grand. I think it's the average income in the United States. And they're like, well, this is of no value to me. But then you offer a program called the Vita program.
So the VITA program, I don't offer that. We do have a program, Tax Smart REI, though.
Okay. So can you explain a little bit more what that entails?
Yeah, absolutely. So Tax Smart Real Estate Investors is all about helping people who want to invest in real estate or are currently investing in real estate leverage the tax code to minimize their taxes, basically, to minimize their tax liability. So it's like, okay, basically the tax code is this big complex blob of legal jargon, effectively.
Mm-hmm.
And most people are not educated on that through their education in public school. And unless you go to school to become an attorney or an accountant, your chances are you have no idea that this world, how deep this world goes. So what we do is we break down these complex strategies that are found within the tax code into a very clear and digestible way that investors can use to apply these strategies to their situation and minimize their taxes. So that's what Tax Smart REI, Tax Smart REI, or Tax Smart Real Estate Investors is, and that's what it helps them do.
How would somebody basically get into the program? I just realized my mic went off.
No problem. So so if someone want to learn more about Tax Smart Investors, there's a few ways to do it. I would suggest maybe starting with the podcast. So we do have a podcast, Tax Smart REI, out on basically all major podcast platforms. And then we have a Facebook community. That's www.taxsmartinvestors.com/Facebook. It's a great community where people are asking questions, and it's free. So free to join. Then we have an insiders community that people could join at taxsmartinsiders.com/insiders, and they can get a 30-day free trial.
Okay, got you. And the links are going to be in the description, guys. So if you guys want to check it out, if it's something you want to invest in, if you want to reduce your tax bill, which I don't know, I always say this, the most people will say that the rich people get taxed usually in a W-2 environment, and that's because they get taxed before they get their money. And I always say this: if you make $1 million as a W-2 income earner, you might as well just, I'm not going to say the word but because it's almost useless, because the government gets the money ahead of time before you do, versus you can't leverage. You can leverage incentives, but if you make $700,000 and you already paid $350,000 in taxes before you saw the money, it's like, it's a no-brainer. But now, in a sense, is to, what about if someone's watching this, right, and saying, you know what, I don't think the economy is stable enough. I don't think, there's people thinking World War III is going to happen. Someone is like, oh my God, we need to stock up on canned food, or during the pandemic, stock up on toilet paper. And they're like skeptical about investing in real estate. Is there anything you could say to that individual right now that's watching this?
Absolutely. The way I look at it is this: real estate, there's still very, very good fundamentals on real estate. What I mean by that is there's a lot of demand for real estate and not that much supply. We have an undersupply and over demand, and that's caused by millennials and Gen Z. They're coming of age to the point where they're ready to buy property, but there's just not that much out there. So if you were to buy real estate and you're able to finance it properly and hold it for the long term, you're going to be in a good position regardless of how the economy does, right? So it's just a matter of, if you zoom out a little bit and look at the long term, you'll see that real estate is still a very solid asset to own, and there shouldn't be much risk. I think where people get into trouble is where they take too much of their capital, the money that they have, and pour it into real estate, and then they've run into trouble in other areas of their life, right? And so the way my suggestion there would be to have an emergency fund, right? Allocate your money. Okay, here's how much I can invest. Here's how much I need to save in the event that I lose my job or my business starts to suffer, whatever the case is. And then you have that runway, you have that capital, or your emergency fund that you can tap into to fund your expenses and still keep your assets intact. So I don't think real estate, the wall is not, the ceiling is not falling on real estate. There's still a lot of opportunity in the space. And if you budget your money right and finance the properties right, there should be no reason to worry.
Interesting there. So now, which kind of brings me into this position here. My for some reason having a little bit of technical issues there. In the real estate side of things, so how much would you say would be a recommended income to have for the most part to be able to? So, like, for instance, let's say someone's got $1,000 saved up. Should they be taking $1,000 and investing in real estate?
No, I would not recommend investing $1,000 in real estate, at least not in like physical real estate. If you have $1,000, that's a great question. If you have $1,000, a good place to invest it might be the stock market. Might be best putting it into an index fund, or some people would say take that $1,000 and invest it into your own education. The best investment is yourself. So go invest it in a course or something along those lines that will provide you the ability to learn a skill that can help you generate even more money. So I'd say probably go through, if you're looking for like a true quote unquote investment, I'd say it's probably best to put that money probably an index fund. But if you want to like invest in yourself, grow your skill set, be able to earn more money, I'd say go invest that in a course that's going to give you that skill.
What would you say is an ideal number to invest in real estate, even if you're going to go either, if you want to go in a syndication per se? What would you say is a good number to put in?
Yeah, absolutely. For syndication, you typically need a minimum of $25,000.
Okay.
Sometimes you need a minimum even more than of 50,000. So it depends. Like that's typically 25 to 50 is usually the minimum for
So
a lot of.
Is that 25 to 50 for an accredited, or is it non-accredited? Like what's the
Yeah. So basically it would be the same in either case. So accredited. So the way accredited investors work is accredited investors have the opportunity to invest in syndications that are marketed. So as a sponsor, if you start a syndication and you use what's known, there's some exemptions that allow you to not be considered a security or like not be regulated by the SEC, the Securities and Exchange Commission. One of those is 506C. That's by far the most popular exemption. And that allows sponsors to go and market their investments on podcasts like this or on the internet, wherever they want to go and do it. And they could take unlimited amounts of investors, but they have to be accredited. So you can't invest in those deals if you're not an accredited investor. But then there's another exemption, 506B, that does allow you to take up to 35 non-accredited investors into the deal. And that you can't market, though. That you have to have a pre-existing relationship. So these opportunities at $25,000 to $50,000 could be available in either case. Now, just real quick, how do you qualify as an accredited investor? You have to, there's a few different ways, but you either have to have a net worth of $1 million or more, excluding your primary residence, or make $200,000 or more for the last 2 years with the expectation to make it this year. Or if you're married, that bumps up to 300. So it's a little bit easier if you're maybe in some cases if you're married, but that's kind of how you qualify as an accredited investor and how the two, what the differences are.
Why would just so what's the premise behind the income? Is it more of a presumption of like, hey, this person is not putting your life savings in this, they can afford to lose the money, or what's necessarily the premise behind, you got to have 200 to 300 grand?
Yeah, absolutely. So these rules were put into place back in the 80s. And so here's the thing with syndications, they're not regulated by the government. So they're exempted from regulation. So if you go invest in a stock, there's a lot of like requirements that publicly traded companies have to provide to their shareholders. You have all these audited financial statements that are audited by accounting firms and basically certifying that these financial records are meet certain standards and certain quality of standards, and that there's a certain amount of information that's disclosed, which makes these investments quote unquote safer, depending on how you look at it. Whereas in private investments, like syndicated investments, these sponsors, the people who are running these deals, don't have these reporting requirements. They don't have to have audited financial statements in many cases. They don't have to disclose a certain amount of information to you. So the thought process behind this is that this is going to prevent this is going to prohibit people or limit people from losing their shirts in a private investment. Like say you go and put $50,000 into a private deal and the sponsor was not, and I'm not trying to scare anybody here, but the sponsor was not totally transparent on how the deal was going to run, or maybe they're inexperienced, the sponsor's inexperienced and loses everybody's money. Well, now all of a sudden you just lost $50,000. And if you were not above these thresholds, that could significantly hurt you, right? So that's kind of the premise behind it. But they've actually started to come out with different rules around this. Like recently, they passed a law that the SEC is going to have to make a test, and that if you pass that test, then you will be considered an accredited investor. And that opens up, that basically makes the income requirement not as limiting as it once was, right? So if you pass this test, you prove that you're educated on how these types of investments work, then you're going to be considered accredited. But to answer your question, it's to protect people who might not be able to sustain a significant loss in capital.
Got you. Interesting. So it's a protection mechanism. Now I'm very curious because I was watching the other day. I wish I could play it, but my computer's been going crazy. A lot of Gen Zers are like, I don't want to buy a house because it's tying me down to like, my, I have to stay here, I have to work this job, I have to do this, I have to do that, I have to do this. So what do you think about the movement of people not of the renter market growing per se? Because now we're getting into more of a renter economy than we are basically in the homeowner economy.
Yeah, for sure. I think it's definitely interesting, and like the internet and the ability to work remotely and communicate remotely, and Airbnb and the ability to travel, wherever you want to go so much more easily, has definitely changed the economy for sure. And I see the Gen Z point of view. So like, well, I like, and I'm not Gen Z, but I'm in a similar boat where I'm renting where I live right now, but I'm still investing in real estate. So that would kind of be my advice, right? Think about it like this. If you know that the rental economy is growing, then you might as well invest in real estate. Now, you don't have to live in that real estate, but if you're investing in that real estate, the demand for rental real estate is going up. That means that your rents will, theoretically go up over time because you have more demand and the same supply, right? Or the supply is not keeping up with the demand, at least not now. So that would be a wise kind of choice to do, right? On top of that, as more and more people demand for these rental properties, the investor demand to buy these would also go up. The appreciation would also go up too. So the value of these houses would go up. So I guess what I'm trying to say here is, the way I would take a look at it is, rent where you live, right? So that you have the flexibility to travel and you're not tied down to any specific location if you don't want to be. But invest in real estate and rent it to other people, so that you kind of get that best of both worlds. And then the worst case scenario, worst case, you can just go live in one of your investment properties. That's kind of the way I look at it.
Mm, interesting. Just tell the tenants, hey, move out. I'm moving in now. The boss is moving back in.
Yeah.
But no. So how do you find the tenants for those properties?
Yeah, so that's a great question. So typically you could put them on Craigslist. You could put your rental property on Craigslist, apartments.com. You can use apartments.com, Trulia, realtor.com. There's all these websites that people go to look for rental properties. So that's kind of like the first stop. And another way you could do it is you can hire a real estate agent or a broker to actually go and find a tenant for you. Now, typically, depending on what type of deals you're in, if you're investing in a single family house, you're most likely going to be finding the tenant yourself, or you're going to hire a property manager and they're going to go find the tenant through like apartments.com, Craigslist, so on and so forth. But if you're buying a larger property, you might have someone go and actually find the tenants for you, like an agent or a broker or a leasing agent, something along those lines. So that's kind of how you'd find it. You either like list it on one of these websites, find it yourself. You could also do signs and things like that. But typically these days they're posted on these websites, and that's how most people find tenants.
Gotcha. So so Grant Cardone talks about single family, multifamily home, the dangers of single family. What's the danger of being and owning just a single family home?
Yeah, the biggest danger in owning a single family home is there's one source of income, right? In that home, on that home. If your tenant stops paying their rent, and you're unable to evict them, like in some states, it's just really hard to evict people. It takes a while. Then you still have to pay your mortgage, assuming you took out a loan on the property. You still have to pay the utilities, the property taxes, the insurance, all of that type of stuff. You're still on the hook for all those expenses, but now you don't have an income coming in. Whereas if you compare that to a multifamily property that say has 10 units, if one unit's vacant, or 2 units are down for whatever reason, someone's not paying rent or they just need to be renovated, chances are that those other 8 units, so those other 8 or 9 units are going to be able to cover your expenses so that you're not in the red, so that you're not like bleeding cash. So that's kind of the risk of having a single family house, is just that one source of income.
Got you. So like, for instance, you were saying something like, I think in the state of New York, you can't evict a tenant even though they haven't made a payment, right?
Oh yeah, I live in New York, and if you basically, the eviction process in New York is horrible. It could take upwards of 6 months. Some people, like in New York City, like you hear stories about all the time about how a landlord's in a legal battle with their tenant, squatting at their apartment for 2 years, and you're like, okay, imagine having a property where you have someone living in your property rent free for 2 years. Right. And that's not uncommon. Like that's not just some far-fetched like one-off scenario. Like that happens all the time in New York. So that's the risk of of investing in single family. But now there's other states like, for example, Tennessee and Ohio, just a few states that I know that 30, you're out. Like if you don't pay your rent, they'll come and evict you within 30 days and you're out. It's it, done. So that process can be very easy in some states, but in other states it's more restrictive.
So doesn't that discourage per se? Because I'm looking at it from a perspective of like, okay, now I want to own property in New York and rent it out. It's just like, you know, someone comes in, pays the first 2-3 months, and next year they're like, oh, sorry, for 2 years I've got it for free. Doesn't that discourage the free market for people to come in and say, hey, you know what, I want to invest more in the real estate in New York?
Yeah, I think it does. And there's a few different ways to look at it, right? Part of it is sometimes the state looks at it like, we don't want investors buying these properties. We want people who are going to live in these properties, buy these properties. Another thing too is, like in a city like New York, you don't want people out on the street, right? Like New York is a dense city. Imagine if, you know, everybody who didn't pay their rent just got evicted right away and they couldn't afford to get another lease, right? Now all of a sudden they're out in the street and it causes problems. So depending on the market, these protections are sometimes for the consumer, and it does indeed discourage investment. And that's an issue in and of itself. But
so what about if the landlord says, I'm not going to pay the mortgage, and now the bank is like, hey,
well, then the bank's the bank's going to foreclose on the property, and either that or they're going to work with the lender. Like sometimes people go into forbearance, right? Like, so for example, say I have a single family rental. My tenant stops paying. I'm going through this lengthy eviction. I can't afford to pay my mortgage payment on the rental property. I might go to my bank and say, hey, look, you know, you could take the property back. The banks really don't want your property back, like, because they're not going to operate your property. They have to sell it. And usually they're going to sell it for less money than it's really worth. So they would prefer, in many cases, depending on your lender, to work with you to basically say, you know, we'll pause your loan payments. We'll pause your loan payments until you can get back on your feet. Now, you still might have to pay the interest back in some way, shape, or form, but at least you're stalling the foreclosure process.
Interesting. No, that just kind of give a scenario of a guy who back in when the 2008 2009 crash happened, he was a what you call this? He's a contractor, and he had this huge land, and basically he had like a huge, you know, bunch of defaults, and he's like, dude, I can't
Right.
I can't pay for this. And he was going to go bankrupt, and his lawyers like, it's been a year, and he's like, did the bank, you know, has the bank come to foreclose? He goes, no. He's like, well, then the bank probably believes that you're still going to make it. And I think a year later, the banks came to him and said, hey, we have a buyer for this. So either you start selling this property to this guy, or we foreclose and sell this property to this guy.
Right.
And then,
right.
yeah, he sold, and then he made his money back, which is interesting to think, because a lot of people think like, oh, the bank's coming out for me. But usually the bank's like, we want to make money, right?
Right.
The goal is to keep the money flowing, not to like get the property and then sell it for like super dirt cheap. But yeah, no, Thomas, it was great having you on. If someone wants to work with you, where can they find you?
Yeah, if they want to find me, I'm on most social media platforms, but the best way to find me is in the Facebook group, and that's the Tax Smart Investors Facebook group. You could just search Facebook for Tax Smart Investors, and I'm in there. So if you want to find me, that's probably the best place to find me at this point.
Okay, guys. So Facebook group, the links will be in the description. So definitely, guys, check out the description to work with Thomas. And then again, like I even learned a lot as far as, you know, the 1031 exchange. I'm thinking about syndication, or just go into the creative financing, you know, finding buyers and sellers. And if it's something you want to do, if you're thinking about, you know, passive income, which I wouldn't really say real estate's passive income, because there's a lot of research that goes into it. But if you want to get into the real estate market, then definitely, you know, click the link in the description, give Thomas a shout. And Thomas, great having you on. And then again, guys, please don't forget to like the video, subscribe to the channel, and if you're watching us on Spotify, hit that follow button. And then again, it's a pleasure having everyone on. You guys take